Government debt addiction refers to the growing tendency of nations to rely on borrowing to fund their expenditures, rather than balancing budgets through revenues alone. In recent years, this issue has become increasingly prominent, with global government debt reaching record highs and surpassing 250% of global GDP. The practice of continual borrowing is driven by the need to finance public services, infrastructure, and social programs, often without raising taxes or cutting spending. As governments accumulate more debt, concerns about economic stability and long-term fiscal health intensify. This phenomenon is not limited to a single country. It is a widespread challenge affecting economies around the world. Understanding why governments become dependent on debt is essential for grasping the broader implications for growth, policy decisions, and future generations. Governments often choose to finance their expenditures by borrowing, rather than relying solely on revenue from taxes or other sources. This approach allows them to fund large projects, manage economic downturns, and address immediate public needs without raising taxes or cutting spending. Borrowing provides flexibility, enabling governments to respond quickly to unexpected events such as natural disasters or financial crises. However, this reliance on debt can lead to escalating obligations over time, as interest payments accumulate and new borrowing is needed to cover existing commitments. The decision to borrow is influenced by political considerations, economic conditions, and the desire to maintain public services. As a result, government debt has become a central feature of fiscal policy in many countries around the world. Over the past several decades, global government debt has experienced a dramatic surge. In the early 1980s, many advanced economies maintained relatively modest debt levels, often below 50% of their gross domestic product. However, successive financial crises, increased public spending, and expansive fiscal policies have fueled a steady rise in borrowing. By 2024, worldwide government debt reached a record $226 trillion, surpassing 250% of global GDP. This sharp escalation reflects not only the growing reliance on debt to finance expenditures, but also the challenges governments face in balancing budgets. The trend underscores a shift in fiscal norms, with borrowing becoming an increasingly central tool in economic management. As debt levels continue to climb, concerns about long-term sustainability and economic stability have become more pronounced. In 2024, global government debt soared to an unprecedented $226 trillion, marking a significant milestone in economic history. This staggering figure now exceeds 250% of the world's total gross domestic product, underscoring the scale of borrowing undertaken by nations worldwide. The rapid escalation in debt levels reflects ongoing fiscal pressures and the challenges governments face in balancing budgets. Such high debt-to-GDP ratios highlight concerns about long-term economic stability and the potential risks associated with sustained borrowing. These statistics serve as a stark indicator of the growing reliance on debt to finance public expenditures across the globe. In July 2025, the United States raised its debt ceiling to $41.1 trillion, marking a significant milestone in the nation's fiscal history. This increase, part of the so-called Big Beautiful Bill, reflects the ongoing challenges faced by policymakers in managing the country's growing national debt. By lifting the ceiling, the government gained temporary flexibility to finance its obligations and avoid default. However, such measures often come with long-term consequences, including higher interest payments and increased reliance on borrowing. The decision also highlights the political complexities surrounding fiscal policy as debates intensify over sustainable debt management and future economic stability. Ultimately, the move underscores the delicate balance between meeting immediate financial needs and ensuring responsible stewardship of public finances. Government debt addiction is fueled by a complex interplay of political incentives, economic pressures, and public expectations. Politicians often face strong incentives to increase spending on popular programs, infrastructure, and social benefits, especially during election cycles. Economic pressures, such as recessions or unexpected crises, can prompt governments to borrow more in order to stimulate growth or stabilize markets. Meanwhile, the public frequently expects continued investment in services and support, making it difficult for leaders to cut spending or raise taxes. These factors combine to create an environment where borrowing becomes a routine solution, even as debt levels rise. Over time, this reliance on debt can become entrenched, making fiscal discipline increasingly challenging. High levels of government debt can have significant economic consequences. As debt accumulates, governments must allocate more of their budgets to interest payments, leaving less funding available for essential services like healthcare, education, and infrastructure. This growing financial burden can limit a government's ability to respond to economic crises or invest in future growth. Additionally, excessive debt may lead to higher borrowing costs as lenders demand greater compensation for increased risk. Over time, this can reduce fiscal flexibility, making it harder for policymakers to implement effective economic strategies. Ultimately, persistent high debt levels can undermine economic stability and constrain a nation's long-term prosperity. The debt cycle begins when governments borrow money not only to fund new projects, but also to pay off existing obligations. This practice, known as refinancing or rolling over debt, can quickly become a recurring pattern. As interest payments accumulate, a larger portion of future budgets is devoted to servicing old debt rather than investing in essential services or infrastructure. Over time, this dependency on borrowing can make it increasingly difficult for governments to break free from the cycle. The result is a growing debt burden that may limit fiscal flexibility and expose economies to greater financial risks. Understanding this cycle is crucial for evaluating the long-term sustainability of government finances. Debt monetization occurs when central banks finance government spending by creating new money, rather than relying solely on traditional borrowing. This process allows governments to access funds quickly, often to address urgent fiscal needs or stimulate economic activity. However, injecting large amounts of newly created money into the economy can lead to inflation, as the increased money supply may outpace economic growth. Over time, persistent debt monetization can undermine the independence of central banks and erode public trust in monetary policy. The risks include destabilizing price levels and reducing the effectiveness of future economic interventions. While debt monetization can provide short-term relief, it carries significant long-term consequences for economic stability. When governments choose to finance their spending by creating new money, a process known as debt monetization, they introduce significant inflation risks into the economy. As more money circulates without a corresponding increase in goods and services, prices can rise rapidly, eroding the purchasing power of ordinary citizens. This inflationary pressure can undermine the stability of a nation's currency, making it less attractive to investors and trading partners. Over time, persistent inflation may lead to a loss of confidence in the currency, further weakening its value on global markets. The resulting volatility can complicate economic planning and reduce the real value of savings and incomes. Ultimately, while debt monetization may offer short-term relief, it poses long-term challenges for currency stability and the financial well-being of the population. Fiscal policy plays a crucial role in addressing government debt addiction. By adjusting spending levels and tax policies, governments can influence the overall balance between revenue and expenditure. Effective fiscal management aims to reduce deficits and curb the need for excessive borrowing. However, political pressures and economic challenges often make it difficult to implement sustainable fiscal reforms. In some cases, short-term measures may provide temporary relief, but fail to address underlying structural issues. Prudent fiscal policy requires long-term planning and a commitment to responsible budgeting, which helps stabilize debt levels and supports economic growth. Ultimately, the success of fiscal interventions depends on the willingness of policymakers to prioritize financial discipline over immediate political gains. Public perception of government borrowing is shaped by concerns over fiscal responsibility and the long-term impact of rising debt. Many citizens worry that escalating government debt could jeopardize economic stability and burden future generations with repayment obligations. Debates often center on whether borrowing is a necessary tool for funding essential services or a risky strategy that undermines financial discipline. Critics argue that excessive reliance on debt may limit the government's ability to respond to future crises, while supporters contend that strategic borrowing can stimulate growth and address urgent needs. These differing viewpoints fuel ongoing discussions about the sustainability of current fiscal policies and the importance of transparent decision-making in managing public finances. Governments often grapple with the difficult task of balancing immediate public needs against the long-term sustainability of national debt. Political pressures can drive leaders to prioritize short-term solutions, such as increased spending or tax cuts, to address urgent issues or appeal to voters. However, these decisions frequently result in higher borrowing and escalating debt levels. The complexities of fiscal policy are further compounded by debates over how much debt is acceptable and what measures should be taken to control it. As debt grows, the challenge of maintaining economic stability intensifies, with policymakers facing tough choices about where to allocate resources. Ultimately, the tension between short-term political gains and long-term fiscal responsibility remains a central issue in managing government debt. Visual representations, such as graphs, charts, and infographics, play a crucial role in understanding the scale and trajectory of government debt. By examining these tools, viewers can observe how debt levels have steadily increased over time, often outpacing economic growth. Infographics highlight key statistics, such as the global government debt reaching $226 trillion in 2024, a figure that now exceeds 250% of global GDP. These visuals also help illustrate the economic impacts, including rising interest payments and the potential crowding out of essential public services. Through dynamic transitions between historical and current data, the complexities of debt cycles and their consequences become more apparent. Ultimately, these visual aids make it easier to grasp the magnitude and implications of government debt addiction. Across the globe, government buildings and financial institutions stand as symbols of national authority and economic power. Yet, behind these impressive facades lies a growing reliance on debt to fund public expenditures. Scenes of bustling markets and ongoing infrastructure projects highlight the scale of economic activities that often depend on borrowed money. This widespread borrowing has become a defining feature of modern fiscal policy, shaping how governments manage resources and respond to challenges. As debt levels continue to rise, the decisions made within these institutions have far-reaching consequences for economic stability and future growth. Government debt has reached unprecedented levels, with global figures surpassing $226 trillion in 2024, over 250% of the world's GDP. This dramatic rise highlights a growing dependence on borrowing to fund public expenditures. Dynamic shifts in debt statistics reveal a persistent upward trend, often fueled by political decisions and economic pressures. The cyclical nature of debt becomes apparent as governments borrow to service existing obligations, creating a loop that is difficult to escape. Key moments, such as the recent increase of the U.S. debt ceiling to $41.1 trillion, underscore the scale and complexity of this issue. These patterns not only shape fiscal policies, but also influence economic stability and future growth prospects. Government debt addiction is a global phenomenon, but its scale and impact vary widely across countries and regions. Advanced economies like the United States, Japan, and many European nations have accumulated substantial debt, often exceeding their annual economic output. In contrast, emerging markets and developing countries face different challenges, such as limited access to international credit and higher borrowing costs. Some regions, like the Eurozone, grapple with collective fiscal rules that complicate individual countries' debt management strategies. Meanwhile, nations with strong export sectors or prudent fiscal policies tend to maintain lower debt levels. These international differences reflect diverse economic structures, political priorities, and approaches to managing public finances. Understanding these variations helps illuminate the complex landscape of global government debt. Addressing the issue of government reliance on debt requires a combination of fiscal discipline and innovative policy reforms. One potential solution is the implementation of balanced budget rules, which mandate that governments do not spend more than they collect in revenue. Strengthening oversight and transparency in public spending can also help ensure that borrowed funds are used efficiently. Some experts advocate for the establishment of independent fiscal councils to monitor government borrowing and advise on sustainable practices. Additionally, reforming entitlement programs and streamlining public sector operations may reduce long-term financial obligations. Encouraging economic growth through investment in productive sectors can increase government revenues, lessening the need for borrowing. Ultimately, a mix of prudent fiscal management and structural reforms is essential for reducing the addiction to debt and promoting long-term economic stability. Assessing the long-term sustainability of current government debt levels raises important questions about future economic stability. With global debt now exceeding $226 trillion, many experts warn that continued borrowing could lead to higher interest payments and reduced fiscal flexibility. If debt levels remain unchecked, governments may face difficult choices, such as cutting essential public services or increasing taxes. Some scenarios suggest that persistent debt accumulation could trigger inflation or undermine confidence in financial markets. Alternatively, proactive fiscal reforms and responsible borrowing could help stabilize debt and support long-term growth. The path forward will depend on policy decisions, economic conditions, and the ability of governments to balance immediate needs with future obligations. In summary, government debt addiction is a complex issue with far-reaching consequences for economies worldwide. Escalating borrowing has led to record-high debt levels, impacting fiscal policy and economic stability. Practices such as debt monetization offer short-term solutions but carry significant risks, including inflation and diminished central bank independence. The political and public debates surrounding debt highlight concerns about long-term sustainability and future policy flexibility. Understanding these dynamics is crucial for grasping the challenges governments face and the potential implications for citizens and markets alike.